So, oops. So I hope everyone's doing good today. I'm going to be speaking about the mortgage and home buying process as put together by Crystal and Laura. My name is Daniel Valencia. I'm a branch manager and senior mortgage banker with Get a Rate Home Loans here in New Jersey. So thanks for joining us today, this afternoon, this morning, depending on where you're located, and we will jump right into it. So I go by Danny, AKA the Bearded Banker. You can find me on Instagram, Facebook at Bearded Banker. I have a bachelor's degree in accounting. I did 5 years in corporate accounting after graduating from college, and then 8 years as a mortgage banker with Get a Rate Home Loans. I've done over $170 million in closed loan volume, and I'm also a realtor and real estate investor since 2015. How I came to today, I am married to Laura, and obviously she helped me get hooked up with you guys and Crystal as well. So, I've known Crystal for about 5 years now as well. So what they're doing for you guys is awesome. Everyone they're putting together to get this information out. I wish I would have learned it younger, but I'm glad that we're getting it to you guys now. So what we'll cover today, first, why real estate? We'll go over some mortgage myths, different types of mortgages, qualification basics, the home buying process as a whole. I'll simplify it as much as possible for you guys. And then I'll give you a pre-qualification example so we can go over some numbers, some figures, get an idea of how that works. And then we'll do a Q&A if you guys have any questions. So why buy real estate? So there's a couple different reasons why real estate is a great investment. You've probably seen this on social media, definitely a lot lately with prices and everything. So number one is appreciation and equity. So appreciation is the value of your property going up, and equity is the difference between that value and what you owe on the property. So as the appreciation goes up, the equity also increases because you're paying the loan down. So that spread, that equity will also increase, which is something that you can tap into for different purposes later down the line. Number two, banks will lend money for property. So this is huge. Real estate is an asset, right? An investment. So banks will lend you 100%, 97%, 95%, depending on the program of the value of the property so you can acquire this asset. So you can't go get a loan to buy stock, right? You can't get a loan to buy a 401k. You have to put your own money in. But with a property, you can buy something for 200,000, 300,000, 400,000 and only put 10 or 15 grand out of your pocket, but you own the whole thing, right? So the only other thing banks lend for is depreciating assets like cars and boats and things like that. But for property, this is definitely something that makes it very unique. Number three, people will always need a place to live. So it's definitely something you want to invest in. You want to have your money in things people need, such as a roof over their head. Number four is cash flow. So you can rent out your properties or your own property or room in your property, right? So you can bring money in to help you pay the mortgage on it. If your mortgage is paid off, it's just cash in your pocket, or anything over the mortgage amount just goes into your account. And then number five is tax benefits. So I think there may be an accountant doing one of these for you guys eventually that can go into more detail, but you definitely get write-offs on your taxes for owning property, such as mortgage interest and property taxes. You get to write these things off to save money on your tax bill every year. So real estate is really one of the only assets that has this many pros to it, if you will, right? Where there's more than one way to really use it to your advantage. So some mortgage myths. Number one, I hear this all the time, that you need 20% down to buy a home. That's false. You can get a home with as little as 0% down these days, but 3%, 5%, much less than 20% down. Number two, you need excellent credit scores, 800 plus. That's also false. You can definitely get a home with average credit. I'll go over some of the details of that in a few slides. And you can't have any other debt, such as student loans, credit cards, car payments, personal loans. That's also false. You can definitely get a house and still have other debt. Obviously, if you don't have other debt, it'll help you in getting approved and what you qualify for. but people close on buying homes all the time with debts in their name, especially student loans. We know that they're, uh, you know, a big thing these days. So different types of mortgages. These are the four basic types of mortgages. At Get a Rate, the company I work for, we do all four of these. This is basically, the most common types. The first one is conventional. So a conventional mortgage is basically the standard of mortgages, and where I guess the normal or regular mortgage information would come into play. This is where the 20% down myth came from, because back in the day when houses were $30,000, $40,000, $50,000 in that range, you could put 20% down and it's only 10 grand. But as prices started to increase, 20% down became a lot more expensive. So conventional loans, they started with 20% down. Now there are first-time homebuyer conventional loans where you could do 3% down, 5% down, different things like that. Also, conventional has the highest credit score requirements and the lowest debt to income ratio requirements, which I'll go over as well. So this is kind of the hardest one to qualify for, but as far as the rates and qualification goes, it's the best, quote unquote. This is kind of the goal, where if you start with any other mortgage, you kind of want to get to a conventional mortgage eventually. FHA is the next one. So FHA stands for Federal Housing Administration. It's a government program. You guys might have heard of FHA a lot if you've seen anything on social media, things like that. This is often confused with first-time homebuyer, because of the F and the H. It seems like this is the first-time homebuyer option. It's not. It's one that many first-time homebuyers use, but you can also have a conventional first-time homebuyer loan. So it's not the only first-time homebuyer option. What FHA did was they came in and said, conventional is getting harder and harder to qualify for. People are coming out of college, student loans, a lot of debt, maybe their credit's banged up, and FHA and the government decided that they're going to make things a little bit more lenient for people. So this one allows for lower credit scores. You can have a little bit more debt and still qualify, and you can have a higher debt to income ratio, and you still get the 3.5% down, which is a very low down payment. There are some extra fees associated with FHA. So, nothing's free, right, in this world. So they're going to get you some way. So there's other fees associated with it, but it's still a great program for first-time home buyers or people that need the extra assistance to get into a home. VA is for veterans. So any veterans of our military, they can use a VA loan, and it's actually 0% down, which is awesome. And USDA is basically for agricultural areas or rural areas where there's not a lot of property, and they also have 0% down options. If the property falls into one of these areas, you can get a USDA loan. We don't do a lot of those. I'm located in North Jersey, metropolitan tri-state area. So it's very busy. We don't have too many USDA options, but if you go further away from the big cities, you'll start to fall into these USDA areas. Okay, so qualification basics. So this is kind of what you need to know if you can even start with getting pre-approved and getting a house. 3 or 3.5% down payment for first-time home buyers. That's obviously if you're not a veteran or you don't fall into that USDA option. 2 years of work history is required. So we want to see that you've been paying your taxes, you've been employed for 2 years, you have a W-2 or something along those lines. It doesn't have to be with the same job. So you can have a 2-year work history and have 4 different jobs in there, as long as it's consistent and it's not going from like a salary position to now you started your own business, or now you're on straight commission or something like that. As long as you've held a job 40 hours a week, and we see the 2-year history, then we can move forward. You need at least a 620 minimum credit score, FICO score. Obviously, the higher, the better. Now, if you're under 700, we're going to gear you towards those FHA options that I was talking about because of the lower credit. Still doable, still great interest rates, but you're just going to get more benefit from going the FHA route. Typically, if you're over 700, we'll point you towards the conventional route, depending on how the rest of the qualification looks. Another note with credit scores, which I'm pretty sure there's another seminar with a credit guy, so there'll be more information there. But when we pull your credit report, we're going to get all 3 scores from all 3 of the credit bureaus, right? Experian, TransUnion, Equifax. And we use the middle score as your qualifying score. So it's kind of like an average. This is national practice. Any bank you go to is going to do the same thing. And again, if that middle score is 620 or better, then we're good to go. They don't all need to be over 620. So you can have, 600, 640, 680. We're going to go with the 640. That's what everything's going to be based on, your interest rates and everything. And you can have up to 4 people allowed on one mortgage. So if you have a cosigner, a parent, 2 parents, you're buying a property with siblings, you can have up to 4 people on one mortgage. And then we look at everything as a whole, all the income, all the debt, all the credit scores, and kind of qualify you that way. So here's a breakdown of the process. I'm going to go into each one of these, but this is a simplified process here. So the first step is to get pre-approved. The second step is the house hunt. Once you're pre-approved, you start looking for houses. You get your offer accepted. You might make 1 offer. You might make 1 million offers. It depends on how the market is and how your offers are. Once your offer is accepted, you'll be under contract, quote unquote. That's when the processing and underwriting process starts for getting the final approval for the loan. Once you do get the final approval, that's considered the clear to close. And usually within a couple of days of getting the clear to close, you're closing, you're signing all the paperwork, and you're getting your keys. So I'll go into each one of these steps a little bit further to give you more information. So step 1 is definitely getting pre-approved. This is, making sure that you are qualified for the homes you're looking at. So you're not window shopping, right? You want to go to the mall with money in your pocket. You don't want to go just looking around at things you can't afford. So this is definitely the first step. Now, a pre-approval and a pre-qualification are not the same thing. Those terms get interchanged a lot, but they're different. A pre-approval is when we verify income, assets, your credit, and a pre-qualification is just based on what you tell me. So towards the end of the presentation, I'll go over a pre-qualification example so you can see how I would do it, but I can do this on the phone with the client. I can do this at lunch. We can do this at dinner, just hanging out, and I can kind of pre-qualify you, but I can't pre-approve you without verifying all those things, because you can tell me whatever, but I have to double check it with pay stubs and W-2s and run your credit, make sure you have the money you say you have, things like that. So that's the difference between the two. Also, one more note on that is that some banks do give pre-qualification letters where they just take the information you give them and put in their system, and they'll send you a letter. A lot of sellers and listing agents that work for sellers won't accept that letter because they know that the information hasn't really been vetted. It's just based on what you told them. So they're really looking for a pre-approval letter. At Get-A-Rate, we do pre-approval letters. We actually do guaranteed pre-approval letters where we will give you as the buyer and the seller each $1,000 if we pre-approve you, and then we can't close the deal based on our pre-approval. Obviously, if something changes, someone loses their job, that's different, but we actually give guaranteed pre-approvals. Once that's in the system, we verified everything, we'll review all the mortgage program options. So again, conventional FHA, VA, all those things, interest rates, and see what makes sense. At that point, we'll issue the pre-approval, or if you can't qualify, we'll create the game plan to get you pre-approved. Sometimes I work with people for a year or 2 years before they get the actual pre-approval letter, but we've been working on getting things in line so that they qualify. So the sooner we can get started, the better. Now, the house hunt. Once you're pre-approved, you're going to connect with a full-time real estate agent. Now, I say full-time for a reason. Everyone probably on this call has, a friend, a family member, someone that's a realtor part-time but has a full-time job, or they work on the weekends, things like that. That's awesome, but a part-time realtor might cost you on either their skills with negotiating, finding properties, things like that, their relationships, because they don't know everyone in the industry, or their time, because real estate is very time sensitive, right? So if you go look at a house that you love and you want to make an offer on it, or you see it online and then someone swoops in and they were able to get there right away and makes the offer, it gets accepted, now your chances are gone. So we always stress full-time realtors because they're going to be able to service you the best. They probably have some relationships in the industry because they do it full time. So, if there's a listing agent that sees an offer from you and you're a full-time agent that they know, they might say, oh, I've worked with this person before. I know that they're good. I know the deal's going to go through, and just give you a little bit of an edge. So we definitely suggest working with full-time agents. You're going to search for homes that meet your needs and wants, that pre-approved budget. So again, the pre-approval is important because it tells us what you qualify for, right? So now you're looking for properties that fit into those numbers, but also meet your needs and wants in a home. So it's a delicate dance we have to do between the bank and the real estate agent, and then with you guys to make sure that we find what's in your budget and it meets all those criteria. Now, the pre-approval can be updated based on specific offers. What I mean by this is when we issue the initial letter, right, it might say you're approved for $200,000 on a purchase with 3% down, and the property taxes are $6,000 for the year. That's the initial letter. But you might find a house that's $200,000 with $6,000 in taxes, and you're going to put 3% down, but you want to offer 180, right? You don't want to just give them what they want. You want to try to negotiate. So what we'll do in that case is we'll give you a new letter that says 180, because we don't want you to give the seller a letter that says 200. Now they know you have more money to work with. They're going to try to get it from you. So we start at 180, then they might come back at 190, and then you say, okay, can I get another letter that says 185? And we kind of go up from there. So we can adjust the pre-approval based on the offers and based on different properties as well. And then lastly here, the time frame is different for everyone. Obviously, the house hunt is very personal. Some people are more picky than others. Sometimes it's one person, sometimes it's a couple, sometimes they have children. I've seen people get pre-approved on a Wednesday like today and find a house by Saturday. And I've seen people get pre-approved and not find a house for 6 months to a year. It really depends on you. After I do the pre-approval, I can either hook you up with one of my agents if you're in New Jersey, or you find your own agent if you're anywhere else, and you start hunting. We'll keep in touch throughout that process just to see how things are going. But until you find a house, we don't really come back to the mortgage process. At that point, you're just looking for the perfect house. Next would be the accepted offer. So now you've made a bunch of offers, or one, hopefully, and the seller has accepted it and signed the contract. So now you've signed it, they've signed it, it's been accepted. This starts the attorney review period. This is in most states, definitely in New Jersey, New York, California, some of the bigger states. Almost always use attorneys. We definitely suggest it so that you have someone that's looking out for your best interest. The attorney review period is when they get the signed contract. You technically have a deal, but now the attorneys are going to go back and forth and make sure that your buyer's attorney is going to make sure you're covered, and then the seller's attorney is going to make sure they're covered for different terms and things like that. It usually takes about 3 days. It can take 3 weeks depending on the attorneys, but it's usually pretty quick. They want to get you in and out of attorney review as soon as possible. Also, at this time, you'll start scheduling home inspections and things like that to make sure the property is safe, it's up to code. The inspector will tell you how old the roof is, the appliances, things like that. So this is when you schedule it. You probably won't actually do it until attorney review is concluded, because you want to make sure you have a deal, but at least you're going to start scheduling things like that. So now you're under contract, attorney review has been concluded. Now you're technically obligated to the terms of that contract. This is when we start the mortgage process. So now you're going to say, hey, Danny, last time we spoke, you did a pre-approval for me. I got that property. Attorney review is concluded. Here's the contract. That's when I start my job again after the pre-approval and say, okay, I got the contract. I'm going to send you the mortgage application to sign off on. Everything is digital. So the pre-approval comes from a digital application. You upload documents to a digital portal, and then you'll sign off on the mortgage application. You'll sign off on the offers. Everything is e-sign and digital. And then we'll start the actual mortgage approval process. So you've already been pre-approved, right? We've looked through everything. We've confirmed that based on what we see so far, everything looks good. But now we're going to go for the actual approval on this particular property with this contract. And at this time is when we order the appraisal through the mortgage company. So we spoke about the inspection, right? That's for structural things, making sure the property is up to code. They'll let you know how old all the appliances are, how old the roof is, make sure the property is in good shape. And then the appraisal is for the bank to know and for you to know that the property is actually worth what you're going to pay for it, right? So if you're buying a house for $200,000, you want to make sure it's worth $200,000. And the bank wants to make sure it's worth $200,000 because we're lending you money based on that fact. So we're not going to lend you, $190,000 on a property that's only worth $150,000, right? We want to make sure that it's worth what you're paying for it. It has to go through the mortgage company as well. You can't use your own appraiser. You have to use the one that the mortgage company has approved because we work with them for a reason. We know that they're going to give us the right value. And it's also, you know, after 2008, after the recession and everything, they put a lot of rules into play. So you definitely have to use a certified appraiser through the mortgage company. So now we go into processing and underwriting. So this is kind of the longest time period of the process. Everything up to this point has been pretty quick, assuming that you found a house quickly. This is the meat and potatoes of the process, right? So processing is getting the file completely approved, and underwriting is what the underwriters do, and they review the file to make sure that it meets all the guidelines, to make sure everything you gave us checks out and that the file qualifies and things like that. So the underwriters are going to review the full borrower documentation package. So this is all your income docs, your credit report, the appraisal, the application, the contract, everything they have so far. They're going to issue what's called a conditional approval. So 9 times out of 10, we're not going to have everything we need right up front. They're going to say, okay, your loan is approved subject to X, Y, and Z conditions, right? They might say, we need an updated bank statement from you. They might say your bank statement is missing page 3, send us that. They're going to need the appraisal to come in. They're going to need your home insurance. They're going to need title work that your attorney orders. So there's a lot of steps involved with getting from the conditional approval to the final approval. The biggest step in that process is the mortgage commitment. So on the contract, when you make an offer to a seller, there's going to be 2 dates that are very important. It's the closing date, obviously, to make sure it works for both parties, which is tentative. It's what we shoot for, but the closing date is usually a little different than what's on the contract. And then the commitment date. So the commitment date is kind of the middle of the process where the seller sees that things are going well, right? They want to know that things are moving and that, you know, you're definitely going to get the loan, because now their property is off the market and they're not taking offers anymore. They're under contract with you. So the mortgage commitment lets them know that, hey, we've checked everything out. The big things are out of the way. So the income, the credit scores, the appraisal, all of that checks out. We're committed to giving this client the money they're going to close. We just have a couple more things to take care of. So that's a big one that sellers always look for. And then again, the timeline is different for every buyer, because everybody's different. They have different things going on. You know, it depends on how quickly the client can work with us, right? So I know some people, you know, let's say they work nights or they have a crazy schedule, their servers, they're not sitting in front of a computer or something like that, or they do landscaping all day, they can't get to their emails, they can't get us what we need right away. So their process could take a little bit longer, right? But if you work a 9 to 5, you sit in front of a computer, you're quick with getting us everything we need, this could really go, quickly for someone like that. The timeline is usually around 20 to 30 days. It could be longer, it could be shorter, depending again on those factors. So the clear to close, these are the magic words, right? Clear to close, we call it a CTC. There's a lot of acronyms in real estate in the mortgage process, but CTC are the magic words. This means that everything's been cleared, the underwriter has approved everything, and now it's time to schedule closing. You'll get the final approval, you'll get the final numbers, right, for what you have to bring to the table to close, and I'll go over that in a little bit more detail as well. And you'll schedule the closing with all parties. Like I said earlier, that date that was on the contract, it might be the same date, it might be a day or two before or after. It could even be a week or two before or after, depending on how things go, but it has to work for all parties. There's a lot of people involved with the real estate transaction, right? It's you as the buyer, it's the seller, or you as the seller if you're selling a property, the mortgage people, the realtors, the appraisers, the title company, the attorneys. There's a lot of people that factor into this, and a lot of people that get paid off of this. So you have to coordinate with all parties. Usually once we get the clear to close, the closing is scheduled like 2 or 3 days after that. It happens pretty quickly because the clear to close is the last thing that we're basically waiting for. And then closing. Closing is where you sign your final legal documents. That's when you become the owner of the property. You'll bring a final certified check from the bank, from the buyer to the, usually made out to the title company. So what this means is that when you start the process, right, there's a down payment, which could be the 3%, 3.5%, or whatever you want to put down. You know, if you have more money than that, then that's fine. And then there's closing costs. Closing costs are for attorney fees, title fees, appraisal fees, all types of fees to get the mortgage, right? So those two things together are going to be detailed on the contract. It's going to say, okay, after 10 days, we're under contract. We want you to send us, the seller's going to ask the buyer to send them maybe $1,000 just for good faith. And then maybe a little bit further in the process, they're going to send them another maybe 5,000, and that's going to come off the top of the down payment, right? And then at the closing, you have to pay for all the other fees. Now, you don't have to cut a check to every person that's due money. All you do is cut one big check to the title company, and then the title company takes it and pays out everyone they need to pay out. So you don't have to worry about it. We just go over the final numbers and say, this is the amount that's due from you. And then the money gets dished out to whoever is owed their portion. And then you get the keys and you celebrate. So at the closing, you typically get the keys. You can go to the property right afterwards. It's yours from this point. And that's when the mortgage is now in your name. You won't start making payments right away. Usually there's a month and a half lag before you make a payment, but this is when the property is yours. Okay, so we're gonna go over a quick pre-qualification example. Don't worry about the math too much on this. It's accurate, but you're gonna get a recording of this. I can even send the slides if you guys need it, so you can kind of do these numbers based on your scenario to kind of get an idea of how it all works. So let's say, for example, a client makes $65,000 a year on a salary, right? Easy numbers. What we do is we take that amount and we divide it by 12 to get the monthly amount. So everything with a mortgage is based on monthly numbers. So 65,000 divided by 12 is $5,416.67. Now, notice that this is before taxes, right? We're not taking out any money for taxes. This is all gross income, it's called. So $5,400, that's the amount that you bring home before taxes. What we're gonna do is we're gonna apply a debt to income ratio to that amount. Basically what that means is that we have to see how much we can lend you based on the debt you can afford. We're not gonna give you 100% of the money that you bring in, because then you have no money left over for living, right? So it's usually, most of the first-time homebuyer programs have a 50% debt to income ratio. So we take 50% of that amount you bring in, that 5,400, that gives us about $2,700. Now notice, if you make more than 65,000, this 2,700 is going to be higher. If you make less, it's going to be lower. It's based on your particular income. Now let's say, so that 2,700 is all the debt, the maximum amount of debt payments you can have per month, including the mortgage payment, with taxes, insurance, and everything included. So let's say the credit report shows a student loan of $100 a month, right? That's how much you pay. It doesn't matter what the balance is, and a car payment of $250 a month. Again, doesn't matter what the balance is. We're worried about minimum monthly payments, what you're obligated to pay to make sure that you cover all your debts, right? So we take that 2,700, we subtract the $100 for the car payment, we subtract $250. I'm sorry, for the student loan, and subtract $250 for the car payment. That leaves you with $2,358. So basically, if I was sitting at lunch with someone and going over these numbers, I'd say you'll qualify for a mortgage payment per month of around $2,350. So first of all, is that comfortable for you? Because again, this is, gross income before taxes, and we're only looking at credit debts. We're not looking at utilities, cell phone bills, groceries, Starbucks, you got a shopping habit, like none of that is in here, right? This is just credit debts and pre-tax income. So a lot of times I'll tell people this 2,350 number, and they'll say, whoa, my max is like 1,500. I'll say, okay, the good news is that based on the numbers you gave me, you qualify for that $1,500 payment you want, right? The bad news is that, we got to see what you can get for that $1,500, right? So now we know, let's go back to this 2,300. Now I have to tell them what they can get for 2,300 a month. And obviously it's going to vary depending on where you're located, but these are just easy numbers. So we have $2,350 for a mortgage payment. Part of that is the property taxes. So we're going to back that out. We're going to take out the taxes, let's say $500 a month, which is $6,000 a year. Depending on where you are, in New Jersey, $6,000 would be amazing. North Jersey, where I'm at, in other states, Arizona, Texas, Florida, it might be $2,000 for the whole year. So it really depends where you're located. But we're going to take out $500 for the taxes. We're going to take out $200 for insurances, home insurance, and other insurances that you're required to get on the house, right? So we're going to take out that $700 total. That leaves us $1,658 just for the principal and interest on the loan. So then I'll take out a calculator. You can Google this stuff too, mortgage calculator. I'm going to throw in 1650 for a payment. I'm going to put in a 30-year fixed loan, which means that the rate's not going to change. It's for 30 years. It's the maximum term you can get. And I'm going to put 3% interest just as a placeholder for now. That's kind of where rates are these days. And based on those numbers, this client would qualify for a loan amount of $390,000 and they'll have a $2,300 payment, and they'll still qualify based on what they told me. Again, I haven't checked everything. This is not a pre-approval, just a pre-qual, we call it, right? So 390 is the loan amount. So when we qualify someone, we tell them the maximum loan amount. If they have, 15,000 to put down, they could look at houses that are 405,000. If they have 100,000 to put down, they could look at houses that are 490. You see how it works? So it's just, we tell you the loan, and then obviously we're going to check how much money you have saved, because it has to be in a bank account or a 401k, retirement, a gift from family, wherever you're getting the money. But if you tell me 20,000 max, that's what I got, then you can look at houses that are 410. So that's kind of how the qualification works. Obviously, the more money you make, the less debt you have, it'll change these numbers, right? Because if we didn't have, let's go back real quick. If they didn't have a student loan and car payment, $350 a month, that's additional $350 that goes just to the principal and interest on the mortgage. $350 could take this, from 390 to 450, something like that, 500,000. So that's how the debt really plays into what you qualify for. So obviously, if you could do this with no debt, you're going to qualify for more. But as you can see, you can still have debt and qualify. Okay. So this is a slide I always kind of end with. You've probably seen this quote before: don't wait to buy real estate, buy real estate and wait. This goes back to the first slide, which is about appreciation, right? Equity. As the prices are going up, you're paying your mortgage, it's going down, your equity is growing. I wish I would have learned this earlier. The sooner you can buy property, the better, just to have it, kind of paying for itself. It's kind of like a retirement plan. It's a forced savings account because you can tap into all that equity at the end of the day. And a lot of times, in communities that we're from and minorities, and, we don't get this information. I didn't learn this until later in life. So the fact that you guys are getting this information, Crystal and Laura set this up for you. This is amazing. If you have any questions, you can reach out to me. I'll give you all that contact information, but this is huge. You've probably seen the memes on, Instagram and whatever, but it's really true. So I always add this into my presentations. And this is all my information, right? Let's connect. So you can visit my website, beardedbanker.com. I have t-shirts, hats, beard oil, a whole bunch of stuff on there. You can visit my company website, getarate.com. There's more tools for different calculators, affordability, mortgage calculators like I was talking about. Feel free to email me with any questions after this. Please follow me. I'll definitely follow you guys back. And everything is free that we do. So the application is free, consultations are free. We don't get paid unless you close, right? So like I was saying in the previous slides, once you cut that last check, that's where the money comes from, to go to everybody that's put in work to get you your property. But everything up front is free. So we just want to talk. We want to see where you're at. We want to help you out. And then the last bullet is all the states that we're currently licensed in. We're adding more. We've been adding 4 to 5 states a year. So this is definitely going to grow. But that's where we're at right now. If you are in a different state and you have questions, I can definitely still help you out. All of these rules and guidelines are national. So everything I do is the same that's going to happen in any state that I'm not licensed in. So you can get all the information from me. I can still help you, walk you through it. I can even see, let you know if someone's trying to take advantage of you. I can look at an estimate and be like, no, this doesn't look right. I can get on the phone with you on your behalf. So I help people, I have family in other states and friends that I'm not licensed in, and I still help them out. So definitely, feel free to reach out if you're not in any of these states. If you are, I hope I can help you out at some point. And I think that's it. I think we can go to a Q&A if you guys have any questions.